All right, welcome to The Explainer. Today we're diving into a pretty provocative theory. The idea that the Federal Reserve is secretly printing money to fight a financial crisis that, according to our source, isn't coming, it's already here.
So the source material we're breaking down today kicks off with this. Pretty dramatic statement, right? It's really setting the stage for a high-stakes argument that a massive, and maybe even engineered, financial event is just around the corner.
And this is really the core mystery, isn't it? The entire argument from our source hangs on this one question. It suggests that something huge is happening, but it's going on completely under the radar, behind the scenes.
Okay, so to really get what they're claiming, we first have to talk about how the Fed usually prints money. Because normally, it's anything but a secret. In fact, it's the exact opposite.
Yeah, exactly. Think about it. When the economy gets into trouble, the Fed usually comes out with trumpets blaring. They want everyone to know they're stepping in, to see them as the steady hand on the tiller, to restore confidence.
And QE, quantitative easing, that's the big one, right? We all heard about it nonstop after 2008, and then again in 2020. It's kind of become a household name. It is the Fed's go-to, very public tool for flooding the system with cash.
Okay, and this is where the source's argument really clicks into place. They're pointing to this new program called Reserve Management Purchases. And they're saying, look, it's basically the same action, printing money to buy bonds from banks, but they've given it this boring, deliberately technical-sounding name so nobody pays attention.
So here's the side-by-side, and it really lays out the key difference the source is pointing to. With QE, it was all about stimulating the economy, loud and proud, buying up long-term bonds. But with this new RMP, the claim is it's a quiet, almost secret cash injection for the banks, and it's all about short-term bonds. The how is almost identical, but the why and the publicity, totally different.
So that brings us to the big questions, right? Why all the secrecy? And why the focus on short-term bonds? According to the source, this has nothing to do with helping the Main Street economy. Nope, this is a targeted rescue mission for a very specific problem that's brewing inside the banks.
Okay, so to understand why the Fed would be doing all this in secret, we've got to look at the mess the source says the banks are in. This hidden problem they're talking about.
And the source uses a really simple analogy to explain this, and it's perfect. Imagine you're in debt. You're not going to sell your house first, right? No, you'll sell your watch, your car, your short-term stuff. The argument is that banks are now at that stage. They're being forced to sell their watches just to keep the lights on.
And this is the heart of the trap. See, on paper, these banks look okay. They're holding all these bonds that will pay out eventually, in like 20 or 30 years. But what if they need cash now? If they're forced to sell those bonds today, that paper loss suddenly becomes a very real, very catastrophic loss, one that could just, poof, make a bank disappear.
And look, this isn't just some abstract theory. The source points straight to the collapse of Silicon Valley Bank as Exhibit A. They were caught in this exact trap. They needed cash, they were forced to sell those long-term bonds, and their book loss became a real bank-ending crisis overnight.
So that begs the question, how's the rest of the system doing? Well, according to the source, there was this safety line for cash reserves at the Fed, $3 trillion. That was seen as the absolute minimum to keep things stable before the 2023 mess started. And here's the punchline. We're now below that line. The system's safety net is gone. The source argues this is precisely why the Fed had to jump in with this secret RMP program. They're basically giving a quiet blood transfusion to a system that's running on fumes.
All right, this is where the theory takes a really wild, counterintuitive turn. Because the source claims the only way to fix this problem is to break something else first, on purpose.
And you're probably thinking, wait, why not just do what they always do? Just slash interest rates to zero. That's the playbook from '08 and 2020. It should make those old bonds look better and solve the problem. But according to this argument, that tool's broken now. It won't work.
So the source lays out this absolutely stunning chain of events. Here's the logic. Number one, nobody wants to buy the bank's devalued old bonds. Two, just cutting rates isn't enough to make them attractive anymore. So three, you need a stock market crash, a big one. That creates panic, and panicky investors pull their money out of stocks and run to what they think is safe, U.S. bonds. 4, that flight to safety suddenly creates a flood of buyers for the very bonds the banks need to sell. And 5, only then, once that toxic asset problem is solved, can the Fed ride in like a hero, cut rates to zero, and fire up the big public QE money printer to save the system. It's a wild thing. And it's not just a theory without evidence. The source points to data just like this. The amount of leverage, borrowed money, propping up the stock market right now is at these crazy highs. The same kind of levels we saw right before the dot-com bust in 2000 and the huge financial crisis in 2008.
Okay, so let's pause for a second. If this theory is even remotely close to being right, what does it mean for you, for me, for everybody else? This is where the whole argument pivots from being a diagnosis of a problem to a pretty shocking prediction.
And a really crucial detail in this theory is the speed of the crash. It has to be fast. A really sharp, quick V-shaped recovery. Not a long, drawn-out depression. It needs to be just long enough to scare people into buying bonds, but not so long that it destroys the real economy for years.
So what's the point of that quick, brutal crash? Well, during that window of intense panic, people are dumping everything. Assets are on a fire sale, going for pennies on the dollar, and the source argues this isn't an accident, it's a feature, not a bug of the system.
And that really brings us to the final, chilling takeaway. The whole analysis frames these massive crises not just as disasters, but as opportunities. Opportunities for a huge, rapid transfer of wealth. It takes us right back to that opening quote, doesn't it? The last chance is coming. But a last chance for who? If this giant transfer of assets is on the horizon, the question we're all left with is, who's about to lose everything, and who is standing by ready to pick it all up?